Something you always need to pay attention to when investing in any ETF are the top holdings. That will give you a great overall picture of what the methodology of the ETF results in practice. When you see the top companies in the fund, you can extrapolate the characteristics of the ETF and understand way better what to expect from it. Because of that, I will go over the top 10 companies currently in SCHD. The top holdings change constantly, so by the time you watch this, they will probably be somewhat different or at least ordered in a different way, but the overall characteristics of the companies will serve as a great measurement of the strategy of the index in the future and what types of companies you can expect to be included. I will first give a brief definition of what the company does, how big it is, and what its current yield is. Then, I will take a look at a few key metrics which are one of the many fundamental metrics I personally use when evaluating companies and which I also teach my students to use. The first one is dividends as a percentage of levered free cash flow. This shows how likely it is for the company to have to cut its dividend soon by comparing the amount they pay as dividends with the amount of free cash flow after all financial obligations have been paid. The lower the percentage, the better. After that, I will take a look at the dividend growth and history. Then, the total liabilities as percentage of total assets. This shows broadly what the indebtedness of the business is. Again, here, the lower the percentage, the better. Next, I will check the levered free cash flow compared to the sales generated, which is one of the key metrics showing the business profitability. With this metric, the higher the percentage, the better. And last, gross profit margins. One of the metrics that shows how good is the competitive mode of the business and how much are they pressured by the competition. Again, the higher the percentage is here, the better. Of course, there are a lot more metrics that I use, but I don't want to make this video 3 hours, so I will keep things short. Okay, let's start in order of the holdings. Amgen is a pharmaceutical company that specializes in making medicines, especially ones that help treat diseases like cancer, arthritis, and other serious health conditions. Currently, the stock has a market cap of $143 billion and a dividend yield of 3.20%. The dividends as a percentage of the levered free cash flow is 43%, which is pretty good and gives the company plenty of room for dividend increases. The company has grown its dividend at a compounded annual rate of 16.75% for the past decade, which is very, very good. It has paid consistent and growing dividends for 11 years. Total liabilities are a massive 92% of total assets, which I don't like to see at all. This means the company has a huge debt. The levered free cash flow margin is almost 38%, which is ridiculously good. Okay, last, the gross profit margin is a very good 74.29%, which shows that the company is very profitable and has a good moat. Of course, the issue with pharmaceuticals is that this moat quickly goes to hell when patents for their medicine expires and cheaper versions enter the market. This is why a pharma company always needs to spend billions of dollars on research and development to constantly create new medicine. Next stock, AbbVie. AbbVie is one of the biggest pharmaceutical companies in the world. They specialize in medicine for autoimmune disorders, cancer, and also in the field of cosmetic medicine. It has a current dividend yield of almost 4% and market cap of $263 billion. AbbVie's dividend as a percentage of levered free cash flow is 43%, which is a pretty good ratio. The dividend growth CAGR for the past decade is 17.16%, a very good number. However, that was mainly due to their blockbuster drug Humira, which is no longer protected by a patent. The company has paid consecutive growing dividends for 9 years. However, this metric is misleading because AbbVie is a spin-off of a company that is actually a dividend king. The total liabilities are 90% of total assets, which is very, very high and a number I generally don't like to see. The levered free cash flow margin is 42.28%, an extremely high number. Finally, the gross profit margin is 70.47%, which is pretty good. The elephant in the room with AbbVie though is how they transition to a world in which their #1 best-selling drug, Humira, is no longer protected by patent and there is a wave of cheaper biosimilar versions of it flooding the market. This remains to be seen. Next company is Chevron. Chevron is one of the biggest energy companies in the world, engaged in the production, refinement, and sale of oil and natural gas. The company is almost 150 years old and is a dividend aristocrat. It currently has a dividend yield of 3.63% and a market cap of $314 billion. Chevron's dividend as a percentage of levered free cash flow is 47%, leaving a lot of room for future dividend increases. The company has grown its dividend by 4.59% annually for the past 10 years, which is nothing spectacular. It has grown its dividend consistently for 35 years, which, however, is an extraordinary achievement for a cyclical business in the energy sector. Its total liabilities are only 36% of its total assets. The levered free cash flow margin is 10.9%, which is okay for the sector. And finally, its gross profit margin is 40%, which is a bit below the average for the sector, but nothing to sweat about. Chevron has been a dependable dividend payer, and bearing in mind the fact that their profit is heavily dependent on fluctuating oil prices, the decades of increasing dividends throughout many ups and downs in the energy markets is an admirable achievement. Next one is Pfizer. Pfizer is a big pharmaceutical company that is 174 years old, which is quite the achievement. We have all heard that name because of the vaccines in recent years. The company generated huge cash during the pandemic that is now looking to deploy to create new medicine and acquire smaller pharma companies. Its dividend yield is 4.83%, and the company is worth $187 billion currently. Dividend is 74% of the levered free cash flow. It has been growing at a smaller than average for the sector 6.23% CAGR for the past decade, and the company has been paying a rising dividend for the past 12 years. Total liabilities are 55% of total assets, which is manageable. The levered free cash flow margin is almost 16%, which is great for the sector, and the gross margin is 69.82%. Again, good for the sector. It remains to be seen how they transition to a post-pandemic world. Next holding, PepsiCo. PepsiCo is one of the biggest consumer staples companies in the world, owner of recognizable brands like Pepsi, Lay's, Ruffles, Doritos, Quaker Oats, Mountain Dew, and others. It has a healthy mix between food and beverages, which gives the company a more diversified product base compared to its main rival, Coca-Cola. PepsiCo is a $233 billion company with a current yield of almost 3%. The dividend is 119% of the levered free cash flow, which is something I generally don't like to see. However, since PepsiCo is a dividend king with over 50 years of dividend increases and a very safe and stable company, there probably is a reason for that, which will require research that is beyond the scope of this video. The company has grown its dividend with 8.13% annually in the past decade, which is pretty good for a company that is over a century old. Also, as I said, the company is a dividend king and has paid a growing dividend for 50 years. Total liabilities are 81% of total assets, which is on the higher side. Levered free cash flow margin is 5.95%, which is nothing spectacular, but it's okay for the sector. And the gross profit margin is 53.69%, way above the average for the sector. Next in our list, Merck. Merck is one of the biggest pharmaceutical companies that has a wide range of drugs targeting cancer, diabetes, cardiovascular, and other diseases. The business has two departments, human and animal health. Merck has a current dividend yield of 2.85% and a market cap of $261 billion. The dividend is over 200% of the levered free cash flow, which is unsustainable in the long term and would require further research. The company has grown its dividend at a 5.94% CAGR in the past decade, way below the average for the sector. And it has a 12-year history of growing it in general. The total liabilities are 63% of total assets. The levered free cash flow margin is okay for the sector at 6.10%. And the gross profit margin sits at 73%, which is pretty good. Overall, the company seems solid, but if I invested in it outside of ETF, I would be worried about the payout ratio and would research what is going on there. Next stock, Broadcom. Broadcom is a huge company in the tech sector with a market cap of $342 billion and a 2.20% dividend yield. Honestly, I am not a tech guy and I don't own Broadcom, so I have never been able to quite understand what it is they do, because from that description my head starts to hurt. Broadcom's dividend to levered free cash flow ratio is 54%, which is pretty good. And here comes Broadcom's superpower, the dividend growth. The company has been able to grow its dividend at a 36.83% 10-year CAGR, which is astonishing. There is no way they can keep that up, as I have said in my other videos, but nonetheless, it's extremely impressive. Broadcom has been paying consistent dividends for 12 years. The total liabilities to total assets ratio is 69%. I can't judge whether that's good or bad because I don't understand their business model at all. Same as with their dividend growth rate, the profitability metrics are great. The levered free cash flow margin is 39% and the gross profit margin stands at 74.27%. Overall, the metrics point towards a pretty solid company. The next company in the list is Texas Instruments. This semiconductor company has a market cap of $144 billion and a current yield of 3.25%. Its dividend is 291% of their levered free cash flow, which is a disaster and requires further investigation into their financials and capital expenditure policy, for which we don't have time here. The company has grown its dividend with 17.6% CAGR for the past decade, which is very impressive. The company has been paying dividends for 33 years, a good achievement. The total liabilities are 48% of the total assets, which is pretty good for a capital-intensive business like this. Their levered free cash flow margin is 8%, which is nothing spectacular, but around the average for the sector. Their gross profit margin, however, is way higher than the average, standing at 66.29%. Okay, we're almost done. 2 more companies to go. If you're finding this review valuable, hit the like button and subscribe to the channel by pressing the notification bell. That way, you'll always be able to see my new videos when they are uploaded and not rely on the algorithm to show them to you. Alright, the next company is Cisco. Cisco Systems is a large tech company with $218 billion market cap and a 2.87% yield. It designs, manufactures, and sells products related to the communications and information technology industry all over the world. The dividend is 35% of the levered free cash flow, which is a very, very good ratio. The dividend growth rate is 9%, which is average for the sector. Cisco has a history of 12 years of dividend payments. The total liabilities are 56% of total assets. The levered free cash flow margin is a spectacular 31.71%, way above the average for the sector, and this is combined with a good 62.73% gross margin, proving the company has a very profitable business. Okay, last company, Coca-Cola. Do I need to introduce that company? We have all been drinking their beverages for years. Coca-Cola is a 3.3% yielding $242 billion soft drink company that owns one of the most recognizable brands in the world and is one of the most dependable dividend payers out there. Its dividend is 63% of the levered free cash flow, pretty good for a dependable consumer staple stock. The dividend growth, however, hasn't been spectacular at 5.21% for the past 10 years. What is spectacular though is the company's dividend history. Coca-Cola is a dividend king with 60 years of dividend increases. The total liabilities to total assets ratio is 72%, which is a bit high, but okay for such an old, proven, dependable and steady business. Their profitability is stellar with 21% levered free cash flow margin and 58.52% gross profit margin. What more can I say about Coca-Cola? Don't expect miraculous growth, but this company will probably keep paying dividends long after we are dead. So, these are the top 10 current companies in SCHD. You may now be wondering if I hold any of them, right? To check my top 4 stocks and ETFs I invest in for the current environment we are in, go to the link in the description and I will send them to your email for free. The report will always be up to date regardless of when you are watching this because I'm constantly updating it. This video is part of my review of one of the most popular dividend ETFs, SCHD. However, I decided to create a separate video for the review of the individual stocks because I wanted to keep the original video review evergreen and consequently create videos reviewing the top holdings, which will probably be different or at least ordered in a different way an year from now. To get a full picture of SCHD and decide if it is for you, check out my ultimate SCHD ETF review, which you can find in the description or by clicking on the video on your screen right now. I will see you there.